It's our philosophical starting point this morning, but let's dig into the hard numbers. Karl Schamotta is one of our regular guests. He's chief market strategist at Corpay, and he joins me here in studio. Nice to see you.
You as well.
I know, I get on my soapbox some mornings, but
that was very thought-provoking stuff there.
At the end of the day, the Federal Reserve is the big story of the day, and they're not going to say too much.
Right.
So as someone who has to try to figure out where we're going, which is what everybody wants to know, how do you think about a day like today?
Right. Well, it is kind of interesting in a lot of senses. I was thinking as you were commenting there about the adjustment to higher rates.
Yeah.
I have a chart that goes back to 1820 showing the U.S. Treasury rate. If you look at the average yield over that period of time, it was around 4.75%, right? So the reality is that in a lot of ways, what we're seeing in the global economy and the Canadian economy and the U.S. economy is a reset to more normal rates as opposed to, bouncing back to something that was, totally freakish during the pandemic. So what we're looking at today is a Fed that is trying to discern whether this economy is going to continue to maintain momentum, whether inflation is going to continue to remain sticky. The last two prints would suggest so, but they do have a lot of arguments that would suggest otherwise, like we're seeing slowing unemployment, slowing employment, we're seeing slowing consumer spending. Those factors could play into a more cautious approach. So today is going to be really key in the sense that we're going to be looking at the dot plot for what Fed officials project for the latter half of this year, but we're also going to be looking to Powell during the press conference for his views on whether all these trends are durable or whether there are storm clouds sort of brewing on the horizon.
And then let's use the context on rates themselves. So in the stock market, there are expectations that we'll see some rate cuts this year.
Yes.
One could argue some of those expectations, more so the U.S. maybe than Canada, because we had an encouraging inflation read this week, but they've been pushed out a little bit.
Yes.
But also there's not calls, it seems like, for dramatic rate cuts. The part that confuses me a little bit is that you've got a lot of people who say the central banks want to make sure that they've gotten through the inflation fight. They don't want to make a mistake. They don't want to have to backtrack because a pivot is a pivot. Once you pivot, you're moving in a new direction.
Right.
But then we also hear people talking about maybe there will be fewer rate cuts, which could make sense. It just seems a bit confusing. Like, are you pivoting and moving towards rate cutting, or are we talking about sort of a pivot pause environment? What are you thinking?
I think they pivoted back in October. I think that's really
that
where
was the pivot point.
Yeah, at that point they started talking, or started definitely conveying that they'd already reached the terminal rate, that the next move was likely to be a move lower. Then, when Powell was doing congressional testimony a few weeks ago, he was saying that they're not far from the point that they would, have enough confidence to begin lowering rates. So markets and the Fed have actually really come into alignment. That's the remarkable part. Like, we were way out of line at one point last year. We had 6 or 7 cuts priced in for the Fed over the course of 2024, while the Fed was saying that we were going to do 3. And we've now sort of converged. And so what Fed officials are consistently saying at this point is that they are going to begin cutting. They know that policy is still in restrictive territory, even though we have, loose financial conditions and the economy seems to be doing well. But once they start cutting, they're not going to, sort of press the brake pedal all that dramatically. They're going to take a pause between meetings. They're going to gradually sort of ratchet that policy rate back toward more accommodative levels, and that means that the trajectory that markets have to deal with is much smoother and more easily digestible, as it were.
Okay, well, let's stay on that theme and let's stick with that idea that the pivot has already taken place. The stock market, I know you're not a stock market strategist, but whether it's the S&P 500 or the TSX, since the fall, we saw a nice move higher.
Absolutely.
We've seen those gains not just continuing this year, but broadening out to more sectors. You've had a lot of the pundits look at history and say, well, in times when you're not necessarily making changes with interest rates, you're kind of in a point where you've sort of called the end of a particular cycle. That can actually be a pretty good zone for stock market investors.
Absolutely.
But we keep obsessing on that point when there's actually going to be a rate cuts. I guess I asked this question because it doesn't seem like we're seeing a wholesale exit from the stock market on interest rate cuts getting pushed out a little bit. Maybe this idea of a slow and steady return to some version of normal is exactly what investors like, even if they realize it or not.
Absolutely, that's the thing. I think that, like, in terms of how the real economy evolves, in terms of how spending happens in the real economy, that's what drives earnings, right? And so what's crazy about this current situation is that the earnings growth has been absolutely fantastic, right? It's not like the 2000 bubble. The 2000 bubble saw price to earnings multiples just blow right out. This time around, we're seeing colossal earnings growth from a huge segment of the corporate population, right? Which means that not only is the sort of higher level of inflation tying into what they're actually earning, but also that interest rate burden is not hitting them that hard. If you look at the nominal level of borrowing or of interest cost across the U.S. corporate sector, it is below where it was 10 years ago, right? So what happened during the pandemic was a terming out of debt and a huge rise in how much these companies are earning. So to some extent, this is fundamentally driven, right? It means to some extent that the corporate sector is insulated from what the Fed does. That's not going to last forever, but at this point, it sure looks like it's going to last through this year.